Welcome to Conversations with My Real Friends. I'm Jennifer. I'm here with my friend John.
Hello, good to
Hi,
be with
John.
you today.
So John is a mortgage lender, and we're going to be talking about mortgage insurance. Most people get kind of cringe when they hear the word mortgage insurance. So what is mortgage insurance, and why do most people not like it?
Well, cringe is an understatement. I mean, actually, when they hear mortgage insurance, they say, I'm not going to buy.
Right.
And so in my book, I talk about opportunity cost.
Yeah.
I talk about two brothers. They both got a $25,000 gift.
Right.
Brother A decided to buy.
Okay.
Brother B decided not to buy.
Okay.
Right? And Brother B said, I don't want to buy because I don't want to have to pay mortgage insurance because I can only put 5% down.
Got
so
it.
I am actually going to wait. I'm going to wait until I have that 20% down.
Right.
And in my book, I say it's 5 years.
Okay.
Right? And so in between that time, I go through the analysis and see who comes out the best.
Right.
And it's interesting to note that Brother A, who went ahead and bought, even with that dreaded mortgage insurance, comes out with a purchase. Now, this is a lower purchase price. This is like a $400,000 purchase price. He comes out better after 5 years to the tune of about $136,000.
Yeah.
But in our market area, where prices are much higher,
Right.
and where the appreciation is happening much quicker,
Yes.
the opportunity cost of not buying now, and I don't want to sound salesy on this. I want to be really careful and be very factual.
Right.
Is that the opportunity cost of not taking advantage of buying now, even with 5% down,
Right.
because you can buy with conventional financing, you can buy a $900,000 home with 5% down.
Right.
FHA, you can do the same thing with 3.5% down. The opportunity cost of not acting now in this area after 5 years is $310,000.
It's a lot.
It's a
of money.
huge, huge number.
Right.
And that's just because during the 5 years, Brother A paid down the loan.
Right.
So there's less there after 5 years when you do a comparison. The property has gone up, and we only did an indexing by 4%, 3 to 4% a year. So it's very conservative for California.
Right.
And the facts is that there's a tremendous cost for waiting.
Right.
And now, specifically what mortgage insurance is, to really answer your question, is that it is insurance to the bank. It's kind of funny because people say, well, what do I get from it?
Right.
And I say, you get nothing from it.
You get a loan.
Right? There's nothing that you get. You don't get any kind of insurance or backstop or whatever that is. What mortgage insurance is insurance towards you defaulting on the loan.
Right.
So if you're putting down less than 20%, because 20% is considered the gold standard.
Right.
If you put down 20%, the bank says, okay, your chances of default are really low.
Right.
But if you put down 5%, the chances are much higher, right? Because you can walk away from the property, you didn't put as much skin in the game, whatever it might be.
Yes.
And so when that happened, a really smart individual said, well, wait a minute. There are people out there that will make their payments at 5% down.
Right.
So I'm going to provide an insurance policy to the bank.
Yep.
So if they default, I will come in with a difference of 15%.
Yep.
I will make it as if they put down 20%.
Got it.
Right? So they will make the bank whole is what that does.
Right.
So mortgage insurance basically makes the bank whole. And what's happening, what you'd really be interested in understand with mortgage insurance right now, I get very animated about this because the rates of mortgage insurance are falling.
Oh, interesting.
Right? So it used to be that they were pretty hefty,
Okay.
but now they're actually going down, and the reason they're going down is because the risk of lower down payments is not as much as lenders pointed out to be.
Right.
And that was because with Dodd-Frank, where you have to prove your income, right? You have to be able to do that. Well, when they prove their income and they put down a small down payment, they still make the same payment, they have the same credit history, they do great. Right? And so mortgage insurance, if anything, what it does is it creates an opportunity for you to get into a home with a low down payment, and you leverage that. See, a lot of people think about this idea of, when you put down 5%, your rate of return is based on the 5%. It's not based on the entire home that you're buying. And so when you put down a small down payment, your rate of return on your investment just skyrockets.
Right.
It's much higher because the down payment, the leverage is there.
Yep.
But it's a safe leverage. It's a leverage where you're actually living in the home. and you've got to live somewhere, and you've got to pay the rent, or you got to make a payment.
You're paying for housing either way.
Right. So you might as well take advantage of
Right.
mortgage insurance and leverage it. Make it work for you.
Right. Makes sense.
Yeah.
So if someone's interested in learning about buying, even if they have to get mortgage insurance,
That's right.
how can they reach out to you?
John, John, John at mainstreetloans.com. Just email me, and I'll be glad to answer any of your questions. There is so much opportunity. It's amazing what you can do when you take a look at less than 20% down payments. At least let us educate you so that you can get an idea of what that's all about.
Great. Thank you, John, for joining me.
You're welcome.
And thank you for joining us for this episode of Conversations with My Real Friends. We'll see you soon.